Welcome to Chit Chat Stocks. This is our Thursday, not so deep dive episode. Comes out on Sundays if you're listening to this in your podcast player, but we also do this live on YouTube on Thursdays at 12:30 Eastern Time, 9:30 Pacific Time.
Wait, Ryan, you had a brain fart there. This is the live episode, the Investing Power Hour, but you said not so
Oh,
deep dive. Yeah,
Investing
RIP to those
Power.
episodes, but
Yeah,
I think the
not
listeners understand. Investing
yeah.
Power Hour, we talk about essentially anything, and you can come ask us questions live. So sorry, Ryan. Continue.
No worries. Yeah, appreciate the correction. Yes, this is our Investing Power Hour. For any new listeners, welcome to the show. We do this, like I said, once a week live so people can ask questions. And then we also post it on our podcast players as well. Today, we've got some news for the week. We are in the heart of earnings season. Lots to talk about, in particular, a coffee giant that has had some troubles with CEO succession, and it seems like they might be in a little more turmoil. So we'll talk about them. Brett's going to talk about Warner Brothers Discovery, and we're going to have our anecdotal evidence for the week. Really, I think it's going to be mostly an earnings-based show today, kind of covering all sorts of businesses. But before we get to that, I want to talk about our friends at Public. Options traders, listen up. I want to tell you a bit about public.com. First, have you ever really thought about all the fees you're paying to trade options? Aside from the regulatory fees, there are commissions, and most platforms charge per contract fees too. That's what makes today's sponsor, public.com, so interesting. Public doesn't charge commissions or per contract fees, and in an industry first, they offer a rebate of up to 18 cents per option contract traded. Check it out. If you trade 1,000 option contracts on Public, you'll get up to $180 in rebates. If you trade 10,000 contracts, you could earn almost $2,000. More importantly, the rebate means you can maximize your profits and minimize your losses. So to recap here, no commissions, no per contract fees, and up to 18 cents on every contract traded. See why NerdWallet recently awarded Public 5 stars for options trading and start earning up to 18 cents per contract traded only at public.com. This is paid for by Public Investing. Options are not suitable for all investors and carry significant risk. NerdWallet overall rating was 4.6 out of 5 stars as of April 2024. Full disclosure is in the podcast description. U.S. members only. Where do you want to start? Should we talk Starbucks? I mean, that's kind of the headline news for the week.
Yeah, I guess that's the number one. Do you think that was the most surprising, at least in a negative way?
Yeah, when I saw the headline transaction number, I was quite surprised. This has, aside from COVID, where there's obviously bad comp sales because of people weren't going to the stores, this was one of the worst looking comp sales years that I've seen, quarters that I've seen for Starbucks in quite a long time. So just for context, total comp store sales, I believe it was minus 4%. I can double check that, but basically pricing, the average ticket, they break it up into two ways. It's average ticket and transaction volume. So average ticket grew 2%, as it always seems to do at Starbucks. They tend to raise the average ticket constantly. They're constantly increasing the price of their coffee. I think everyone kind of knows that. But transaction volume declined by 6% relative to last year. So that is quite the steep drop off. Brett, if you have the chance, maybe you could pull up the FinChat KPI on it.
I will give me a minute. I am tweeting out the link, but yes.
Okay. So
1 minute. I'll add some data for us.
yeah, there's the stock dropped, I want to say, maybe 20% in total after earnings. I know it was down like 15% the day after, but this is closest. I believe they are in the largest drawdown since the great financial crisis relative to the stock's highs. I think it was down 41% from recent highs. So Starbucks has kind of been one of those bellwether companies that's been pretty durable and tends to get a premium valuation because they have sort of that latent pricing power. Or they seem to have that pricing power that they can always tap into. However,
Historically had that pricing power.
yeah, we're starting to see some weakness here. And I think what really got people concerned here is that, yes, the numbers were bad, but then the new CEO, Laxman Narasimhan, I might be pronouncing that wrong. I apologize. He went on Well, first of all, the conference call after wasn't that reassuring. And it kind of seemed like he didn't have that great of an idea why the struggle was happening, which sometimes it's hard to diagnose that within a business. Netflix had a quarter where subscribers didn't meet their guidance, and they're like, we don't really know why it's happening right now, but we're going to try to figure it out and get the ball back on track. And it kind of seems like that was it. He tried to diagnose it as long wait times for mobile orders was deterring sort of the average, not loyal customer. But then he went on CNBC and kind of got torn apart in this public interview. Jim Cramer, which I know everyone has their own opinions on Jim Cramer.
First off, don't go on Mad Money. He's just trying to get some clickbait clips, so
Yeah.
either positive or negative.
Yeah, and some of the stuff he said kind of made sense, but he basically kind of came at him and was like, Tim Hortons, Dunkin' Donuts, McDonald's all say that you're losing share in out-of-home coffee. And Laxman didn't really have a great response. And maybe some of that's just like economic struggles, like the macro situation. People are moving more towards value coffee as opposed to, the $7 orders that you might get at Starbucks. But it seems like they're really struggling right now to get people in the doors, and they're struggling with throughput. 6 months ago, they released, and this is probably the funniest thing I've ever seen, the triple shot reinvention with 2 pumps plan to really reinvigorate growth at the business, which is just a hilarious name for a growth strategy. I guess my question to you, first of all, did you look at the quarter? Second of all, do you have any sort of faith in Laxman here? Do you think Schultz is going to end up coming back? What are your thoughts?
Ooh, well, that's a lot. That's a lot of thoughts there. I did read the quarter. Seemed bad. Pretty much all around. Margins are going down. Transactions are going down. They're raising prices a little bit. Something seems to be off. Will Schultz come back? I don't know. Maybe.
And the union they're still struggling with the union efforts.
Yeah, that's tough. Historically they had a really good relationship. But I think part of it might be they give out a lot of stock to their employees. It's probably a small thing, but if stock's been flat for 5 years, it doesn't matter as much. What data point did you want to look up on?
Go to the transactions.
Okay, so segments and KPIs.
So
they got a lot of those.
Yeah, and you'll kind of see after, and if you go to quarterly as well, you'll see kind of the breakdown. And it's been like comps have been pretty good following COVID, but this quarter was sort of the worst quarter they've had. Here's my other concern.
Where is the?
It's towards the bottom.
Towards the bottom. Comparable company, comparable transactions growth?
Correct. Yes.
Okay.
So, yeah. So I guess for context for listeners, we are using FinChat right now. They are one of our sponsors, but we actually, we use them every single day. So we're more than happy to have them sponsor the show. And comp transactions, keep in mind, this is basically foot traffic at the stores is a way of thinking about it. This was down 6% year over year. The previous 10 quarters have all been positive except for a couple, but the ones that were negative were still hardly negative. So this is by far kind of the worst, most difficult period they've had since COVID. My concern is kind of broader than just mismanagement. There is some evidence that people are moving away from coffee in general. People are moving more towards the ready to drink energy category.
You're saying another Celsius killer. Or sorry, Celsius is killing another business, Ryan.
Yeah, I don't know. Here's one of my issues, and I tend to do this pretty frequently. Starbucks has kind of been seen as a great business it's generated really good returns for shareholders over the years. Lots of pricing power. And if before this quarter, if you ask someone, what do you think of Starbucks? I bet most people would say like, good business. Coffees are a little expensive, but they seems to work. Now they have one bad quarter of transaction growth, and all of a sudden everyone's like, we knew this was coming. The prices on their coffee are too high. And all of a sudden you start to rationalize the drop with a bigger picture issue. Instead of me thinking like prior to this, I thought it was a good business. And the reaction I probably should have is it's a short-term blip for a business that's probably going to have a good next decade. But instantly my mind goes to, oh no, the energy category is taking share from them. This is in a terminal drawdown. The industry is kind of screwed. And I wonder if all that is just wasted mental effort.
Yeah. We got a comment here that says it's pretty amazing that they guided to 17.5% 2024 earnings growth on January 30th. And then by March 31st, they knew earnings per share was down 14% and then waited till May 1st to guide to no earnings growth in 2024. Let's see. Comment here that says pricing also too stretched while core customers are squeezed, millennials and Gen Z. Question, was Starbucks a casualty of labor inflation? They needed to raise prices at the same pace as wages to maintain margins, but customers don't want to pay the higher prices. Yeah, definitely. I mean, if inflation is tough, especially from a wage perspective, they're going to be a business that gets hit. And we've seen generally, I mean, McDonald's, I think, reported it too. w- a lot of these restaurants right now, it seems like there's a macro headwind where a lot of people, just because of the food affordability issues out there, and then you also have places like California that are forcing the minimum wages higher. That's causing a lot of people to transition, at least on the margin, to making more food at home. And that could be what's hurting Starbucks. I do have some anecdotal evidence on the CEO. So, randomly, a year ago, I got a DM from someone I've never talked to. This is actually, it's 2 years ago, almost November 21st, 2022. So, I think I tweeted something about the new Starbucks CEO coming in, the one you just mentioned. And this guy said he's toxic randomly. This person, anonymous account, DMs me and he says, I'm looking to short when he gets into the role. And I asked him why, and he said, we did work on him as a successor at Pepsi. He referenced poorly. His tenure at his previous place was bad, destroyed a lot of value despite talking a good game and bounced when he saw the top. Some notes for you. Don't, yeah, he said, don't share that part. He said also did some dodgy things with accounting at his former employer, and it's scary that Starbucks went for him. He has no retail experience and is very weak operationally. Yeah.
Wow, that's not a glowing review at all. That is,
And then I tweeted that I didn't share I guess the person, keep that anonymous, but I said a random anon account told me that the Starbucks CEO was not good, essentially. And then he came back and said, "Told you so." And he was definitely right. And then I was like, the guys, well, after watching that interview and kind of reading, I'll pull up the press release. I have something that might seem like it doesn't matter, but it's concerning to me. I said the guy's vibes are off, and he said again he's a short. I'm telling you, he is a short. So the guy's conviction is still there. But let me pull up the press release from Starbucks because there was something in the report that concerned me. Again, you talked about how they had the what was it, the three pumps, something.
the triple shot reinvention with two pumps.
Yeah. So here's what they said in the press release just over the quarter. I'm going to read it to you and see what you think. Quote, in a highly challenged environment, this quarter's results do not reflect the power of our brand, our capabilities, or the opportunities ahead. It did not meet our expectations, but we understand the specific challenges and opportunities immediately in front of us. We have a clear plan to execute, and the entire organization is mobilized. We are very confident in our long term. I know that our shot reinvention with 2 pump strategy will deliver on the limitless potential of this brand. I mean, that's a lot of nothing right there, isn't it? I think I'm concerned that this is McKinsey speak, this is consultant speak, this is just like they're not he he didn't say anything there. Where it's like, "Okay, what are you actually gonna do?" It's like, "Well, we're reinvigorating the brand." It's like, "No, no, no, what are you doing?"
Yeah,
You
what
know?
are the concrete steps that you are
Exactly.
making on the at the store level to get people to get higher throughput? And he didn't give any context about it. And the other thing is it's not a trade secret. It's not like he's afraid to say it because McDonald's is going to replicate it. Like McDonald's is doing just fine. Your stores are very different. Just
And their coffee strategy is for the lowest, cheap,
yeah,
cheap, cheap, the lowest for the out of home coffee.
you know, when Schultz came back in, part of the I guess concessions that he made with the labor union was he told them, well, first of all, he said, we're cutting our dividend. Or yeah, we're stop. No, it was either the dividend or the buyback. He said, we're stopping it. And then he restarted it, whatever, 2 quarters later. But he also created voluntary tipping. And I think that eroded the customer experience a bit. It made
Yeah,
it
you
feel
oh,
like every
so
other coffee place where you're paying a little
they're doing the
extra.
same thing as your local coffee shop where they flip it around and ask for 20% right off the
Yeah.
bat.
Yes.
That's yeah, and that actually is an underrated awkward situation. I'm researching a little teaser. My next stock I'm researching for to do a research report for the podcast is Portillo's, and the CEO has multiple times prided himself in saying, "We don't do the auto tip for a fast casual chain. Us and Chipotle are the only ones that don't do that because it really adds a lot of awkwardness and friction with the customer base, and it's underrated, and they wanna eliminate that." I didn't know that actually could be an underrated part, but I still
Be,
think the vibes of the CEO are the most important thing here, where
yeah.
it's just too consultant, too political. I don't know if he's actually understands what's going on.
Yeah, I agree. And you raise a good point where it's not only are you paying more if you have to tip, right? First of all, that's one way for Starbucks to pay their employee, quote unquote, pay their employees more without actually doing it themselves, right? They're just asking customers to tip. Second of all, it does create that friction where all of a sudden, okay, when I go to Starbucks, I get black coffee. They turn around, they put it in, they just hit a button and it fills it up itself. Like it's a nice nifty machine. I'm not going to tip 20% for that. Sorry. I'm not like the full blown anti tipping culture, but that's kind of a ridiculous ask. It
Right.
makes it uncomfortable to not tip in that situation. And it kind of deters me from going back because I just don't want to deal with that.
Exactly. Yeah, 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 yeah. We don't need to do a whole philosophy thing on tipping, but I totally agree with that. Let's see. We have a question here. Maybe last one. The comment that says, "How do these?" Well, I won't say what type of CEO. These CEOs convince boards that they are the person in the search process. I think
I
it's just the
don't know.
consultant pipeline. I think it's the consultant pipeline because they have all these relationships at all these executive suites, and that's honestly, I'm not. It's one of the biggest red flags I look for is just consultant pipeline to executive suite, which you know how they get there because the consultants have all these relationships with the executives, and I don't actually know if they understand how to do their job. I would have so much more confidence if it's an internal hire that worked their way up through the organization and just went to a state college
I
and
totally
didn't have
agree.
any of this prestigious consultant stuff going
They
on because
know
it
the
just
business. Yeah, those internal hires know the business. You look at a company like O'Reilly, it's either the CEO or the CFO. He was he has been there for what was it, 26 years. He was mopping the floors of one of the early O'Reilly stores, became a store manager himself, and just slowly worked his way up. Same with the Ryan McInerney at American Express. He started as some manager in like 20 years ago. Those people know the business. They've seen it
yeah.
evolve. They're not coming in with these like platitudes and generalities of what works for businesses. They actually have an idea of what works. I think you're right.
Okay.
I would totally prefer an internal hire.
All right. We've done a lot on Starbucks. Final thoughts. You said something about how part of you is screaming that it's a buy.
Yeah, and then I remembered the China exposure. To be honest, like there was a part of me that thought everyone's soured on it right now. Kind of reminded me of Dollar General in a way, where it was kind of a darling retail concept for a while. All of a sudden, everyone sours on it after one bad quarter, and maybe you can kind of just catch a fallen angel that way. But the China exposure does concern me. Luckin Coffee's having a lot of success over there, whether it's real success or they're just printing
Yeah.
fake tickets again. Uh,
Hey, they're not afraid to be aggressive. I'll tell you that much. So if they want to sell stuff at cost and drive prices down, that could be,
but
you
but
know,
Starbucks is struggling there. They've had less progress than they were expecting. So that tells me that either someone else is winning or the coffee market isn't as large as Starbucks thought in China. So no, I'm probably not going to touch this.
even if I had confidence in everything, like okay, even if I had confidence this was a short-term blip and the financials are at least or something like the moat is intact in the short run or something, and I had no worries about the China exposure, this CEO would keep me out. It has to matter. These are very important things, and it's one of the ways an individual, I think, can have an advantage is to be very how do I say it? Have a high bar for your management teams. All right, next one. Do you want to hit Warner Brothers Discovery? We have a question here from listener, and I know he's joining right now. I see him doing some comments here, and one of our sponsors of Firm Returns on Warner Brothers Discovery. I think a provocative question when I asked for one, and did make me think a lot. But I think there is a couple of differences here. So here's the question when I asked for suggestions for today's show. The parallels between Warner Brothers Discovery and, quote, any mature tobacco company. Both have a legacy business in secular decline. Both have a growth engine that could replace the declining revenue from the legacy business. Both generating cash and have very low valuations. Why isn't Warner Brothers Discovery right up your street? Now, I got some numbers for us to, I don't know, help with any sort of context. Try to go through this. Stock down 34% year to date. It's been severely underperforming the market. Sentiment really couldn't be worse. I mean, everyone hates the stock, right? I mean, if you go for like, without looking at the numbers, you're like, yeah, you kind of just get that. You're like, that sort of vibe with the company. But if you look at the financials first, free cash flow is actually growing. $6 billion in 2023 free cash flow. They haven't reported Q1 yet, so we'll see what happens then. But the stock's been down, I believe, on Paramount numbers. So I think it was just stuff on that and probably the sports rights stuff as well, which we'll get into. Market cap is only $19 billion. So we have $6 billion in free cash flow, market cap $19 billion. I mean, that's easy, right? Well, I'd argue not exactly. First, I'd say there's two things that concern me. Well, maybe three. But first, and this is the one that anyone can see when kind of getting a first look at the balance sheet and the earnings, is they have a lot of debts. So according to Q4 2023, during the IR presentation, they have $44 billion in gross debt. Now, average maturity on that is about 15 years. So they have plenty of time to pay it back, as long as cash flow remains positive. If you do $6 billion in cash flow a year and you have $44 billion in debt spread out over a decade, you're going to be able to pay that back. It's not going to be a huge deal. But I think the question is, and the big question is, will the cash flow remain stable? Will it remain positive? Now, if you look at the segments here and, Warner Brothers Discovery, they have the legacy business and then the streaming business, and they also have their studios business. But if you look at their earnings, $9 billion, and perhaps the majority of their adjusted EBITDA comes from the networks, which is the legacy TV business. And I think I would just have a lot of concerns that goes away rather quickly. If we're doing an analogy to the tobacco business, there are a lot more fixed costs here. And I think there's a lot more uncertainty. Yeah, like the tobacco business, they could decline. It could go from 6% to 10% declines, but I don't think there's any risk that it's going to literally go away in 2 to 3 years, right? And I think that there's a case here, and there's not very much pricing power that they can pass on because they have all these fixed costs. And I also think that with all these fixed costs, if pay TV, as it continues to decline, the profitability can erode rather quickly. And then I also think that they're in a tough position with sports, right? The NBA rights are in a bidding war right now, and I think that presents really a lose-lose situation for them. I mean, that's been a cornerstone for them, NBA on TNT, all that stuff. If they win the rights, well, they probably can't afford them. I think it's similar to Paramount with the National Football League. But if they lose the bidding war, they are at risk, I think, of heading into a subscale era with sports. They, I think, lose a lot of relevancy for people in the United States and then continue to lose market share to someone like Amazon, Netflix, YouTube, and Disney. And then if we look at their DTC numbers, they weren't desirable for me either. Subscribers are essentially flatlining. I mean, they're growing a little bit, but ARPU is barely budging. It's about, if I'm going off of numbers, probably half of Netflix's numbers in the United States. I, I think the difference between me and like a Philip Morris International for Warner Bros. Discovery is one. I think the predictability of the legacy business, even if it's declining, is a lot higher for me, especially because you have the pricing power that's still there, even if earnings are going down. And second, they don't own the premier brands within the new age. If for this would be streaming versus nicotine. For the new age nicotine product, pouches, vaping, et cetera, heated tobacco, the safer stuff. It's like Philip Morris International owns Netflix, but Warner Brothers Discovery, I don't know if that's ever going to be profitable. Their streaming operations. I think the big question here is there $44 billion in value here to clear their debt size? I think there is some uncertainty here. Things could go wrong where if sports rights really get reshuffled and streaming finally takes the hurdle and everything goes streaming, that network's earnings goes away quickly and you have a large fixed cost base. But that's a lot of talk from me. Ryan, what are your thoughts?
Yes, I don't. For Warner Brothers Discovery specifically, I don't have any thoughts on the valuation. I haven't looked into it enough, but just from a basic understanding of the core business, I don't like the analogy with, um, especially Philip Morris International, but big tobacco in general. I get the whole good company, bad company situation, or kind of new company, legacy company
Right.
style
Under
analogy.
one stock,
But
yeah.
first of all, for Philip Morris International specifically, their cigarettes or their combustibles portfolio really isn't declining much at all because it's internationally. And so I know a lot of our listeners are in developed markets, the US, the Nordics, England, that kind of stuff, where combustibles has really declined. That's not really the case for Philip Morris International. I think cigarette volumes were down 1% year over year this quarter. And on the flip side, when we look at the new businesses, the let's call them Zyn versus Paramount, for example. For Zyn, it costs 5 cents to make a pouch. You sell it for $1. There's incredible customer loyalty, and you can raise prices consistently, and you have 76% market share in the United States. For Paramount, you are competing on price with everyone else. You are competing for content spending with everyone else. It's hard to.
There's no proven unit economics.
Yeah, and maybe they have 2% market share in smart TV or streaming TV time spent. Like, if we were making the analogy, like if Warner Brothers Discovery had Netflix as their second or as their new business, maybe. But even then, that's 8% market share of streaming TV versus
75, yeah.
75% share for nicotine pouches. I just think the business characteristics of a tobacco business are much better than a streaming business where it's kind of a crapshoot and everyone's throwing money at it. There are not that many startups in the nicotine pouch space. And if they are, it's really hard to get to scale because really it's hard to do a whole lot of marketing. So I
And the
definitely,
regulations, yeah. Yep.
I
Okay,
I
we
don't
have a
love the
comment here
analogy.
that yeah, look, it's so cheap it might work. I think it could work. Look, you just need the TV networks business to generate, similar amounts of cash for a couple more years. Honestly, you don't need that long of a time period. They can pay back. They can get the debt to a more manageable level, and then you see what you have left in D2C with this new age business. Maybe they can execute. Look, got a comment here that they're doing account sharing restrictions in tandem with the House of the Dragon. I guess maybe I'll watch that show. I did watch the first season. Maybe I'll resubscribe. But I think what will keeps me out of this is that historically this is a good business because of the cable bundle. The cable bundle is paying them. There's also you have the bundle stuff that they don't even have to work for. It's a really 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 nice business, and the competitive set was rational. Now we have YouTube, Apple, and Amazon, Netflix maybe in the sports rights. I just think it's a whole different ballgame with these people these new competitors that exist because they don't care. I mean, Amazon is going to bid for these NBA rights. They're seeing they're going to be the highest bidder for some of these, and they don't care that they're going to lose a little bit money on it because it's irrelevant to someone of their size.
Yeah, I
So
agree.
I just don't see why if they have no sports rights, why do I subscribe to Max? Because of HBO? I just think that producing shows like that is sort of a commodity.
Uh,
Amazon produced that Fallout show, it got 70 million viewers. Netflix produces all these types of shows. They just had the new one, The Three Body Problem. Like these premium shows, Apple has shown plenty of skill in doing that.
I
Why
agree.
buy for this DCC business when you know that okay, maybe the debt can get paid back by this legacy business that generates cash and then goes away. But what am I buying?
Yeah, I agree. The other thing is, it's never been easier to switch. It's never been easier to switch off the service, right? I love House of the Dragons. I think it's a great show. Or as an extension of Game of
The
Thrones, I
Game of
like Game of
Thrones
Thrones
style
too.
stuff. Yeah.
And maybe I'll subscribe for 2 months while the episodes are being aired, but then I'll turn it off. It's a lot easier to kick that subscription to the side than it is to kick a nicotine addiction to the side. So we're talking about like
Yeah.
which business is stickier. I definitely would say tobacco. But I just don't. I think it's a totally new competitive set. You're right. It might be cheap enough that it just still works out anyways. But aside from Netflix, I wouldn't want to own anyone in streaming TV.
Yeah. And Netflix is expensive now. It could work. Like, I don't know. I could hear an argument for it. I just think there's a lot of uncertainty, and I'd rather play. Plus, we talked about executives. The Warner Brothers guy likes to pay himself a lot of money.
Zaslav.
Yeah. He has it tough because his name is so funny that headline people remember who he is and then all the headlines go after him. But
Yeah.
I think he's fine. He gets paid enough to get attacked like that. All right. What do you want to do now? PayPal? Or do you want to talk some of our sponsors first?
Let's talk about our friend. Speaking of better Warner Brothers Discovery coverage, because he has write-ups on it that are definitely more thorough than kind of our surface level thoughts. Let's talk about Firm Returns. Firm Returns is a stock research blog ran by a friend of ours, and it covers stocks from all over the world, leans more towards the United Kingdom as that's his home market, and he has easier access to management. He has companies like Tiny Build, Warner Brothers Discovery, as I mentioned, and there's an archive of long form write ups that you can access for free. There is a paid tier if you want to get 4 in-depth research reports on new companies each year, but I really do encourage you to just look at it. If you're interested in Warner Brothers Discovery at all, go get some of that free coverage and see if you like the writing, and then you can check out the more in-depth research reports for the paid tier as well. Like I said, he covers a lot of the companies that we don't talk about on the show, a lot of undiscovered UK stocks, and he's size agnostic. He'll cover companies with market caps of $10 million all the way up to $40 billion. So I really, really do recommend just going and checking it out. If you go to firmreturns.com/chitchat, you will get your discount 20% off. And if you just go to firmreturns.com in general, you can access all the great high quality write-ups. So I'll leave it at that. But yes, go ahead, check out Firm Returns. Second friend I want to mention here, earlier in the show, you heard us talking about the investing platform, public.com. That is where you can trade options with no commissions or per contract fees, and you get a rebate of up to 18 cents per contract traded. NerdWallet recently gave Public 5 out of 5 stars for options trading. And if you want to see why, go to public.com and start getting a rebate of up to 18 cents per contract traded. This is paid for by Public Investing. Options are not suitable for all investors and carry significant risk. NerdWallet overall rating 4.6 out of 5 as of April 2024. Full disclosures are in the podcast description. US members only. Earlier in the show, we did mention FinChat too. I'll take a moment to just do that right now. If you like FinChat, if you like the charts we're showing, if you're looking for a stock research platform just in general, which I do highly recommend. It saves so much time. FinChat.io/chitchat gets you 15% off any of the paid plans. We've actually had a ton of people using our code. So I think it shows you if you're looking for social proof, there's a lot of people that seem to be getting value out of it. So
And we
go check
highly
out the
appreciate
platform.
it.
Yeah.
And me and Ryan, all the people here at Chit Chat Stocks, well, there's just one other guy, Brady. But we appreciate that very much, and it helps us keep producing the show. All
The
right.
man behind the glass. That's what we have to refer to him as.
The man behind the Riverside virtual studio recordings. All right, PayPal. This is a fun one. If there was another company that people wanted to talk about, it was definitely PayPal. Let's see. I want to make sure we're hitting up any. Yeah. Yep. James.
I'll tell you
Firm
what, if I
Returns
were
in the
PayPal,
comments says details in his free write-up. Okay, you go ahead first. I'm loading up stuff.
if I were PayPal, I would simply stop reporting my take rate.
Just earnings.
Maybe I'd simply just stop reporting earnings, but you obviously can't do that. No, the take rate is such an irrelevant metric for them that I honestly probably would stop reporting it. I know it seemed like a bit of a red flag, but because I mean, I guess it doesn't matter because you can just look at the revenue as a percentage of payment volume, so you can find the take rate anyways.
Okay,
But
I'm going to read these highlights off to you. Total payment volume, 400 billion. Year-over-year growth, 14%. Revenue, 7.7 billion, growing 10%. Foreign exchange neutral. Non-GAAP operating margin of 18%. And they say under our new non-GAAP methodology, we include the impact of stock-based compensation. So that's nice.
It's a good
They're getting
adjustment.
a little bit better. New management team seems okay. Now let's look at account and activity. I'll pull up some charts here for you too. Active accounts declining 1% year over year. Monthly active accounts. I'm sure that's just people that are actually using the platform. 220 million flat, 2%. Number of payment transactions growing 11%. Transactions per active account growing 13%. They have a lot of stuff here that breaks out Braintree and Venmo and all that stuff. Okay.
The most important metric is revenue for these guys. Just to be clear, it's payment volume. As Braintree grows, I mean, Braintree competes with the likes of Stripe and Adyen. It's basically, I think it's mostly used as a gateway, but it's kind of a full payment service provider, and their volume, much less of that goes to PayPal themselves. So the payment volume itself, I don't think is a super relevant metric, but revenue and then whether or not they're reining in costs are probably the two most important things here for shareholders.
Yeah, I mean, they have to, through marketing and promotions and stuff, regain accounts and try to acquire new accounts. I think, okay, you look at this chart here we have on FinChat, what other nice KPI things. If we go back to 2020, 2021, they're adding over 10 million each year each quarter. Yeah, this is quarter. Each quarter, starting in December 2019 through December 2021, they added 10 million accounts. Now, if we go to 2022, they were adding about 3 million. And then if we looked at last year, they started losing active accounts. So they had net new active accounts of minus 2 million, minus 2 million, minus 3 million, minus 2 million. Now, this quarter, they stemmed the bleeding a little bit, positive 1 million. What do you think about that, Ryan? Is that a good? That seems like a good. That's not. It's better than they've been doing, right?
It's a step in the right
That's not bad.
direction. It's a step in the right direction for sure. The only concern for me is Venmo is growing. Like to some degree, it's got to be growing. That network effect is so strong that I'm sure it's adding some accounts. So my concern with the general decline in active accounts over the last year is that the core PayPal service, which is their cash cow by far. I mean, they have like if you use PayPal to pay at checkout and you use cash in your account, all the entire take rate goes to PayPal there. They have all the economics. That is their cash cow. That must be bleeding if net new active accounts are declining when Venmo has 60 million active users and it's definitely growing.
Continues to grow. Yeah. And here's the thing, though. I have another chart we're sharing here. Operating income hit all-time high over the last 12 months, 5 billion. I mean, it's up from 2014. It was only 1.3 billion. It's just compounded, except for 2022.
They're generating interest income,
but I still
on cash held in the account, so operating income doesn't even include that.
Yeah. And I guess you can add that in there as well. They have a benefit from that now with interest rates rising, but I still have your same concern. Another thing that no matter whether this quarter was good or bad, that over the long term concerns me is the exposure to high fee foreign, basically cross border currency, not currency, P2P payments and payment stuff where Wise, Remitly, all these other players are coming in and lowering costs for cross-border not transactions like with a merchant, but sending money to people. And that's been their cash cow as well. Now, it's hard to see why someone would stick with PayPal there when we've had this experience before. We worked with cross-border payments. We've said, at first people are like, oh, let's use PayPal. And then you look at the fees and it's like 2%. And then we go, no, let's just switch to Wise because the fees are going to be like 0.3 or 0.4%, or maybe even lower if it's like Canada to US dollars. Why can't everyone do that? It's not like Venmo where there's a network effect where it's just, oh, we'll send some money here. But we'll see. Look, I think a lot of that's priced into the stock here, and the new management team seems to have a better head on their shoulders. So TBD, and I don't know PayPal well. Maybe there's some better green shoots in the quarter, but seem kind of the same as it has been where, yes, earnings are good, but there's still some things they need to turn around. And hopefully it looks like they're being more honest with investors. But what's weird is that there's all this sentiment that's negative, right? And earnings just keep climbing higher. Like eventually it doesn't matter.
Yeah, here's the way I kind of look at it. If as a collective, all of PayPal's other businesses, so unbranded checkout, aka Braintree, Venmo, what are some of the other ones? Zelle, Honey, whatever. If all of their other businesses as a collective can replace the cash flow from branded checkout in the long run, I think they're going to be okay. But I worry about branded checkout on its own. As you mentioned too, with international transfers, we've had international advertisers on this show before, and we've opted for Wise. And if someone were like, let's use PayPal, I would be like very reluctant to do it just because of the take rate. I think they are asking people to eat away at their market, and that seems to be happening right now, especially with Wise. Wise is probably just getting low-hanging fruit from PayPal churning customers.
Yeah, I'd say so. And some other people out there as well. There's not just Wise. Let's see. We have some questions here. Here's a good one. What business do you guys think is more relevant 5 years from now? PayPal or Match? And I'd say more relevant, not compared to the two, but compared to
Where they are
where
today.
the company is today.
Match. I would
It's a
say
good
Match Group.
question.
So okay, most of the dating apps for Match Group are growing. Tinder is, in terms of like active users, I think it's maybe flatlined a bit, but still in general, it's PayPal, I would imagine, declines quicker, especially for the branded checkout
Yeah,
than
it's
Match
it's not
Group's
like
active users.
the competitive threat is not upending the entire business model.
Yeah, I mean, for Match Group, it's really
You
not
know
the
what I mean?
competition at all. I think it's more just a byproduct of paying users specifically. It's a byproduct of probably the price increases, but just overall online daters and hitting maturity in some of their more developed markets and maybe being
Yeah.
replaced by themselves, right? Hinge replacing Tinder, uh, or stealing users from Tinder, most likely. So uh, I would guess that as a group, Match Group probably more relevant 5 years from now than it is today. PayPal, I would venture to bet it goes the other way.
Yeah. Okay. Other questions. Do you still like the look of Wise, Ryan? I think you are doing that for your next research episode. So look, couple weeks on that one.
Yeah, I'm torn. I'm also looking at AutoNation. I found them pretty interesting. So I might be looking at them as well. I will say,
Yeah.
Wise, very attractive. This kind of leads me to my anecdotal evidence for the week. I use Wise pretty frequently, both for work and we use it for the podcast as well. It's a good business, or it's a great customer service, I would say. Great customer experience. They pride themselves on being a low cost provider. I think it will replace a lot of wire transfers, a lot of international transfers, and a lot of like bill pay from international business. So yes, I like the look of Wise. I think they're adding functionality that is actually helpful, like for the business model, for example. So the Wise card, Brett, you've used the Wise card before. The Wise account gets you, I think, a pretty high interest rate right now. So there's reasons to keep your money with Wise and not just look at it like a Venmo. With Venmo, for the most part, you're really just transferring money and then giving it back to your bank account, and there isn't a whole lot of take rate on it. Whereas Wise, I think they can really start to drive different ways of adding value and capturing value from the company's perspective.
Okay. Yeah, we have some questions on Wise. Yeah, James, one of our sponsors, says I just paid an international invoice using Wise, and he sent the winky face emoji. I was like, well, okay, thanks for that one. Let's see. Here's a question that leads into something I also want to talk about. We didn't talk about Adyen last week, um, because like every European company out there, they can't seem to get an organized IR page. But I found the numbers. Don't worry. The question is from John Doe: is there any real difference between all these companies? Is the difference just take rate and fees? Now, there is one thing which we talked about. If you want to listen to a full episode on it, I'd highly recommend going back and listening or watching what we did on Adyen. I think within the last year, but it's still relevant. One thing that is very important, especially when looking at Braintree and anything merchant related, where you're basically processing stuff for merchants, is I forget the exact industry term, but it's essentially the approval rate, where if someone tries to purchase something, it works, and what your rate is on that, because that can save a large merchant a lot of money. Now,
Authorization.
authorization rate. Thank you. All right, I want to add in here and get your thoughts, because the stock's down on their Q1 update. It's not a full update because they're European companies, so I think they just have to do uh every 6 months. Forward EV to EBIT, now this might be the bull market talking, is down to 31, Ryan. They said that their revenue growth is still intact to grow at about They still think they're 20% plus, kind of the mid-20s range is a good target for them. They still think they're on track for that, and they still think they're on track to hit their EBITDA margin expansion back to above 50%, which is EBITDA is a pretty good number for them. That translates fairly well into cash flow. Right now, EBITDA margin is slightly lower. So my thinking is you have to believe them, but yes, you have the chance to grow revenue at about 20% for a while. And there's a chance for margin expansion. So earnings could grow pretty rapidly over the next few years. Is the stock cheap here? 31 times forward earnings.
Cheap? No, but I'm happy you told me this because I'm going to do a little digging after the show. This is one I do want to own. It's in my want to own at the right price category. And if you didn't tell me what the forward EBIT was, I probably would have just neglected it for a little while. So I'm glad you mentioned that. These things between Stripe and Adyen, I think they're so well positioned to continue capturing volume. And having now been in a bit of a startup, kind of a company that's trying to move quickly, you can see the advantage of not being a patchwork of acquisitions. Like a lot of these legacy payments companies, so much of their time, if you're an employee, if you're a developer, is spent on going back through old code bases that you acquired, going back and like revising old, like a lot of maintenance work as opposed to new growth oriented work where you can really try to service customers and add value and add new products. Adyen, because they've been built from the ground up and it's not a patchwork of different acquisitions, they can just diagnose problems quicker. They can move so much faster. I think it's an actual like true big advantage. And they are simpler for a merchant to integrate. If you go through the old system, there's the merchant acquirer, there's the payments processor, there's the payments gateway, and you can have all these disparate solutions, or you could just have a total payment service provider in Adyen, which has higher authorization rates as well. It's kind of a no-brainer. So I think they're going to continue to capture volume, and I don't know if I'd call it completely cheap here, but I like the way they run their business as well. On this kind of a side note here, did you see the Stripe statue?
Yeah, that was funny.
It blows
With
my
the
mind.
famous Italian marble.
Yeah. First of all, okay. Second thing, what are they doing publishing books?
I know.
This is you can't scheme up a better business than Stripe. They process $1 trillion in volume. How are they not profitable? I'm sure maybe they are like slightly profitable. I've seen like little tidbits sneak out that they are somewhat profitable, but Adyen is generating 60% margins as they should because it's at its core such a profitable business.
Yeah. When I say Adyen has been in the past, now it's a little bit lower as they said they invested a little ahead of growth to acquire some employees, some strong employees they found. I think the question or the answer is just employees. They hired a lot of employees. They publish books. They do a lot of other things, Silicon Valley style. Yeah, there's a lot of expenses out there. I think with Adyen, yeah, it's maybe hitting the buy zone. I think for my watch list, like it doesn't mean I would actually buy it. I got probably 5 or 6 on the watch list that I would buy once I deposit more money into my personal account. Maybe it ends up there, but if it falls even further, yeah, I'd love to start a position. And I think, look, I'm pretty confident. Like, obviously, it's not guaranteed to be right. I'm pretty confident they can grow earnings at least the same level as revenue, probably higher over the next 3 to 4 years. And if you have 30 times earnings, growing revenue at 20% with probably expanding margins, if you think they deserve a premium multiple, which I think they do just because the churn is so low, yeah, and you're inflation protected, I don't think this is the worst place to put your money if you're long term. Obviously, short term, who knows? Just given the valuation, but long term, I think things go well from here. It's
I agree.
obviously not as good as when it was at 20 times trailing for that short period in October of 2023, but
For like a
that seemed
month.
like a once in a decade valuation.
Did you buy during that
Here's
time?
okay. Hey, could have happened again. Hope I jinx it. Let's see. Comment here. Yeah, let's see. I've integrated Stripe into a few websites. Great product in the main, but if you start using any more niche features there are loads of bugs. Yeah, what are all those employees doing there? They should focus on payments because that's part of. Okay, listen to if you want full thoughts on payments. I would listen. We did a whole theme on them last year. I believe in June. So go back and listen to those. And we did a full episode on why we really like Adyen stock. That's over an hour long. Go listen to that if you want full thoughts on that company. But I want to close out, Ryan, with Amazon. 10% EBIT margins. What did you
Hey,
think?
that's probably one of the only times in my life where I was like, here's my model. It could hit 10% EBIT margins, and it did it. Like, that felt pretty cool. But I didn't really own it during the time frame, so bummer.
During this year, yeah.
Yeah, I guess Jassy's not a total bum. So for everyone that was hoping Bezos would come back and replace Jassy, I think I'm okay with Jassy in there. I'm like, you know how we have our mentally short and our mentally long buckets where they're not actually in our portfolio, but we believe in the
We just
company or we
argue
don't
that they're
believe.
good. Yeah, it's kind of like the takes on online.
This is at the top of my mentally long bucket. The I constantly come back to the fact that they probably have one of the deepest competitive advantages in corporate America today. They spend when you take off at an airport. I was looking through this, and I keep a running list in my phone. I tweeted about this the other day. I keep a running list in my phone of businesses that when I come across them in real life, and I like think, wow, that's a powerful business model. I jot them down. The other day, I was taking off, and I saw like 12 Amazon Prime planes parked right next to each other, and I just thought,
Yeah.
there's no way anyone's catching this logistics advantage, and they're spending whatever 65 billion a year on capex. It's a business that's going to have a logistics advantage probably for 2 decades. I think this is a good business, and
Yeah.
I think retail can be profitable. They have advertising, which is certainly helping, but I think they could get closer to profitability even without advertising. I would not be surprised if margins continue to expand.
Okay. Within 3 years, do they hit? No, this is gonna be a tough one. I'm kind of exaggerating a little bit. I don't know if they'll actually get there. Within 3 years, do they hit 20% consolidated operating margins?
I don't think they'd hit 20%. I think they could be high teens, but 20%'s reaching. Yeah, I don't see 20%. It depends how much AWS makes up of the pie, but just given how
Yeah.
much they'd love to reinvest, it seems pretty unlikely. They have been. I would love to know the split on advertising revenue between promoted listings on the Amazon core website and where else the advertising revenue is coming from, because I'm getting advertisements on my, I don't want to say it too loud here, the robotic device I have in my kitchen that belongs to Amazon. I get ads there. I get ads
Yeah,
on
that's got to be
Prime
irrelevant.
Video. I get
Prime Video.
ads. There's ads all over, and I'm starting to use more and more. I'm consuming more and more Amazon products outside of just being on the Amazon website. So I would love to know what the split is there. Just like, where's the ad revenue coming from? And
I would guess the smart devices are quite low, just given that the numbers on no one using them. Prime Video, they just started adding the ads in a at a higher rate. I know they had them on some of their sports products, but I'd say that's more of a growth opportunity, and maybe we'll see. It could be a larger piece of the pie in a couple of years, but I'd say the vast majority has to be sponsored listings right now. And I think they mentioned that before without giving out any concrete numbers. I'd guess 80%. It's such a
yeah,
good business for the sponsored listings. And honestly, it's one of the things that I think would concern me a little bit because it is I guess it's similar to Google search, but honestly, even worse, where it's like you just have to pay up to stay where you would be already because a lot of this, I don't know. A lot of the sponsored listings are listed right next to like the same product right next to each other, and you just have to click the sponsored one or not, and like it's not that big of a difference. You kind of get what I mean, right? Where I, I know the value is there, and I know they have the captive audience, but I worry that that it is a bit aggressive, and that regulators might have a bit of a true bone to pick with them in that regard.
Yeah, I I I know what you mean, and I don't know if having a bunch of promoted listings adds value to the customer experience. Like it's almost like Brian Chesky kind of came on and said like anyone can just do promoted listings on a marketplace or a platform. It's easy. It's like kind of one of those things you do maybe when you're running out of ideas um, to raise margins. It doesn't seem like it's really like degrading the experience though on Amazon, at least anecdotally from what I've witnessed. So I'd
It still
say,
seems fine to me.
yeah, just let it keep
Yeah.
going. The only bummer about Amazon doing so incredibly well is that more and more of the business is slowly becoming AWS, which when I read the conference calls, I'm just a little lost. Like they're talking about all these
Yeah,
different
yeah.
developer initiatives, and I'm like,
I know what
well,
S3
I'm
is.
like, I think that's good, right? That sounds cool. Oh, Bedrock,
Yeah.
that's must be very important. And it's just
All
kind of,
all yeah. I
I
know
just look
one
at the
thing,
growth rates.
S3. That's it. That's it. Yeah. Simple storage. Yeah. Well, let's see. They have a comment here that says sponsored listings are definitely pushing the envelope on what they can get. I think that's what's really is driving the margins. The thing is, the only worry here is regulators because they basically customers aren't going to be too upset. Like Ryan mentioned, I don't think it really degrades the experience that much. Yeah, you might get a bit annoyed if you see a couple of sponsored listings, but when you're searching for products on Amazon, as opposed to like getting a subscribe and save for rice or something, it's kind of a browsing experience. So it's not that bad that you have sponsored listings, and it's not that different from a store where Levi's will promote and pay to be, have that center thing at a physical location. But they are squeezing the merchants in this regard a lot. I think that's one of the the merchants complain a lot, and you see all these documentaries and all these reports on that. And I think the advertising payola kind of sponsored listing stuff is the one true gripe that I think I can get behind, where it's a little bit egregious. But the other third party seller services, I think that's just an amazing business
Yeah.
where that one is just yeah, yeah.
It's the classic them turning a cost center into a revenue generator where they've built out the infrastructure. Why not use it? The fulfillment by Amazon, it was just kind of one of those perfect, made all the sense in the world businesses where you can let other e-commerce platforms like the Wix or the Big Commerce, even Shopify. I don't know if they peeled it back or not, but let
Oh,
those
you mean
merchants
do you mean buy with Prime
buy
too?
with Prime, not fulfillment. Well, yeah, buy with Prime is kind of leveraging that same
Leveraging. Yeah, exactly,
infrastructure,
exactly.
but uh, yeah, fulfillment by Amazon is not. I was talking buy with Prime. There's just a big value unlock. There's so much they can do once you have that infrastructure advantage. It just gives them, and I hate to use this word because I know it's overused, but it does give them so much optionality.
Optionality, yeah. That's a great way to end it. We okay. Well, I think this is a fun earnings report episode. Let's see. Maybe I'll do the closeout. We do these live every Thursday, 9:30 a.m. Pacific time, 12:30 p.m. Eastern. We are recording an episode on Stan Druckenmiller this week, which will be quite fun. The man who called Nvidia and Ozempic, well, the weight loss drug stocks, one of the best investors ever. We'll go through the details of how he invests and what we can learn as individuals from him. We're also doing a research episode on Portillo's. That will be mine. And then Ryan is TBDing, but potentially Wise, potentially AutoNation. I'd probably vote Wise because it's a little bit sexier for driving in new listeners, but
Hey,
that's what people can look
AutoNation,
forward to.
Shares outstanding over the last 20 years down 82%.
Hey, all right. Well, that's a good tease right there. We can toss that right into the title. Let's hit the disclosure. We are not financial advisors. Anything we say on this show is not formal advice or recommendation. Ryan, I, or any podcast guests may hold securities discussed in this podcast, may have bought them in the past, and may buy, sell, or hold them in the future. Thank you for everyone that tunes in live or listens on the podcast player of choice. We'll see you next week.